All right, so this panel is DeFi Llama, Metrics Madness, separating value from vanity. And the topic of this panel is going to be all about metrics, on-chain metrics. If you've been in DeFi for a while, good chance you have encountered DeFi Llama at some point. In case you haven't, we are a on-chain metrics dashboard focused on transparent methodology, open source. But even if you have encountered us, you may not know the extent of what we track. We track over 5,000 protocols on 366 chains, over 20,000 yield pools, 686 dexes for volume, and what's the last? We track over 700 protocols for revenue. Got it. So we track a lot of stuff, and actually all the data is available through our API. So if you're looking to build with it, TVL and the other important metrics are available through the free API, and then everything is available through our Pro API for $300 a month. So if that sounds interesting to you, come talk to me at the break. All right, with that being said, we've got a stacked panel today. I'll let everyone introduce themselves because there's a ton of them, but we've got people from a variety of ecosystems, chains, protocols, researchers, and we're going to talk about which metrics are actually tough to fake and which ones are most useful. And you can just kick it off, Anders.
I'm Anders. I run institutional and DeFi BD at the Jito Foundation. We're the largest DeFi protocol on Solana, and we have the main validator client as well.
I'm Wesso. Whoa, sorry. I'm Wesso. I'm an advisor at Beefy, and I'm also the CTO at Cap, which is a new stablecoin that's launching soon.
I'm Jack still. I'm at Verachain.
I'm Steven from DeFi Dojo.
Brian Culligan from AlphaGrowth. We help run DeFi protocols.
Felipe at Theia. I'm CIO there. We are a long-term focused, fundamentals focused liquid fund.
All right, so we got a lot of perspectives. The first one is going to be from your perspective. Which protocols which metrics are the highest signal for measuring chain and protocol growth? And I guess we can just go right down the line here and then maybe get into a discussion.
Yeah, I think it's using just one metric is not very wise. So I think a lot of times people try to just slap one to measure anything. I think if you had to pick one, it would just be fees or revenue. But for something like LST, it's really just TVL because your fees are a function of that. But for something like an exchange, if you have a bunch of deposits but no one's trading, TVL doesn't work very well. So I think it kind of depends on the protocol. But I think if you had to choose one, it would be fees.
So I think we're starting to change a little bit. I think people were always measuring it based upon TVL, which is really kind of a poor metric to compare protocol to protocol. So like you're comparing a lending protocol or a decentralized exchange or a yield aggregator, and you're comparing by TVL, they're all going to have massively different amounts of TVL just based upon how they actually function. I am most importantly, and I'm really kind of glad that DeFi Llama is starting to showcase actual revenue. I think it's also needed to change or look at fees a little bit differently for a decentralized exchange, because I think a lot of people promote high fees that actually don't go to the protocol themselves. But how much actual revenue is a protocol generating? Are they actually profitable? Are we actually going to have at some point DeFi protocols that are making money? And so transparently we can start to see that kind of stuff at DeFi Llama. But something that I look at and I start to measure, it's something that we care about a lot at Beefy because we wouldn't have been able to operate without actually making money. We focus on how much yield depending on the amount of TVL. So TVL isn't as important to us. It's more about the actual fee generation we can create. So I really think it's protocol to protocol specific, even though I think a general metric a lot of people still lean on is TVL.
Yeah, I directionally agree with all of you guys, but that's not as fun. So I think largely speaking, the way I kind of frame it a lot of the times is TVL has gotten a lot of hate lately, which I think for a while was justified because people were over-representing how much TVL mattered. But TVL does still matter in some capacity, right? And I think there's like two broad forms of TVL that I think about. The first is bridge TVL. That's like how much capital is in your chain's bridge contract in some capacity. And that you can think of as like the true TAM of if I managed to create such good applications that people deployed 100% of the capital that they had ever bridged over to my chain, this is the maximum amount of liquidity that I can access. And then the second is also application TVL. That's like what DeFi Llama really focuses on measuring. That is like, I think, significantly more important because that's actually looking at this measure of like, okay, within the applications and the ecosystem, who has actually created something that is interesting enough for people to deploy capital into? As these guys mentioned, though, it's not sufficient in and of itself, right? Because there are a bunch of ways to generate a lot of TVL that's like completely unproductive. But at the same time, right, like the way I kind of think about it is you have like some business framework within your DeFi or application protocol broadly that has some sort of like effective margin on it, right? That is like the profitability of the protocol relative to like the amount of capital that they have. And that might scale with TVL. It might scale with different types of TVL, like stable LPs on a DEX are going to be generating significantly less in fees than like a volatile LP, right? And so even within the same application or the same vertical, different assets and different types of TVL actually just have different outcomes for a project. And so there's obviously like a lot of nuance there, but broadly speaking, it's like, okay, what is the fee generated by this asset on an average basis? What is like the TVL in that asset within this application, and then extrapolating out for there and trying to like optimize on that curve is kind of how I think about it.
So I'm going to come at this from like an LP perspective because that's typically who I work with. DeFi Dojo, we're all about the yields. I call myself a yield monkey because I'm just always sort of scanning protocols for the best possible opportunities. And in doing so, you can be blindsided by crazy high APRs. And I think anyone here who's ever done DeFi yield farming has probably been blindsided by a crazy high APR. Shout out to Ohm and Last Cycle. Anyone who was participating in that. Worked good for a long time. Hey. But now, when talking to more sophisticated LPs, family offices, hedge funds, one of the biggest metrics they actually care about, I'm going to sort of copy you, is TVL, because TVL is effectively a statement that is, there is this much capital that trusts this protocol, this much capital willing to participate on this protocol. And then what you have to look at is a vanity metric versus a value metric. So a value metric is where is the yield coming from and what kind of yield is it? So we're looking at staking yields. Native staking yields are typically the most common type of hardcore robust yield that people like to play with. And so looking at Verachain, there's the BGT yield that's coming from Bex fees sold into Honey. That's like a kind of real yield, and that real yield is being redistributed to people. And so being able to look at that and say, we know where the yield comes from, therefore we're not the yield, and then we can go play with it based off of the trust in the protocol, which is typically based off of TVL. Volume, for anyone here who likes to do liquidity provision, is the other big metric that is meaningful. Even if there's wash trading, which we all know in this industry there's a lot of, that benefits liquidity providers because wash traders are still paying fees on that liquidity. So if you are, I hate to use the word mercenary, but if you are a farmer and you are looking for the best yields, those are the sorts of metrics you're typically looking at. And I think even though they may not provide the same sort of value for the fundamental analysis of the chain's coin, they are providing the value for a farmer's perspective who's seeking out good opportunities to deploy capital.
That's cool. Yeah, I mean, fees at the end of the day is what everybody's about. And if you kind of construct a funnel from like a user journey, you have an impression, that impression leads to a view, that view leads to a click, the click leads to a wallet connect may lead to an approval, may lead to TVL, the TVL uses the utilization. Once you have it, the asset utilized, it eventually ends into fees. So each step of the thing, I would kind of frame it a little bit differently. Yes, fees at the end of the day are like what matters the most, but when you're a protocol or you're an ecosystem, you kind of have to look at it from the top of the funnel, from impression and brand and narrative, all the way down to the fees that are generated. And attribution in DeFi is extremely difficult. So if you're able to do that, you're going to be able to optimize your funnel, you're going to be able to optimize your campaigns, and be more effective as a protocol or as an ecosystem.
So I agree with everybody who said it depends, because it depends on every protocol. You can build a model for basically any business with 3 or 4 variables. AAVE is borrow times average interest rate times take rate. And you can do that for every business, but it'll be different, right? A front end will be volume times fee. And that gives you a sense of how much a business is worth. So, we have like 5 to 7 different business types in the industry, and then each of those has its own model in our view. From the token holder perspective, if I had to pick one, it would be revenue minus incentives. We didn't talk about incentives a lot. It distorts a lot of the numbers that we see on all these data sites, but incentive-driven volume does not prove PMF. Incentive-driven TVL does not prove PMF, and what we're looking for as long-term investors is actual customers who like to use the product without being paid more to use the product than they're paying the business, right? Apple doesn't pay anybody to buy iPhones. You pay them to buy iPhones. So the last thing I would say is 2 metrics I didn't hear about here are just number of customers and retention. A lot of exchanges have very few customers with high volumes. That's not as stable or as attractive as an exchange with 10,000 or 100,000 customers, right? You don't want to depend on 300 people getting washed out. And the other really important one is market share. A lot of these businesses have economies of scale. As they get bigger in market share, they become more durable, more sustainable. Think of 2 examples, Uniswap and AAVE, and their market share over the past 4 years. We really look at that when we're looking at businesses.
There's actually 2 things I think I've heard, not everybody in the panel. But there's actually the trust assumption. So I think if you don't have enough TVL, you're never going to gain actually the trust from users to deposit. As a liquidity provider, also if you don't have enough TVL, you're never going to gain large liquidity providers because they'll dilute it too much. So TVL does really matter, especially when you're smaller and you're getting started. I think even when you're comparing against competitors, you might have an advantage in the trust side with TVL. As for valuing how successful a protocol is, it's not a great indicator, as you said. I also think that there's some missing metrics that we really don't have in the DeFi space, like users. Like people can kind of make up users or whatever, but like that's a really important metric. Like how many people are actually utilizing the protocol and how many are organic users, and how widely is that from the competitor, in opposed to just TVL, right? So there are still like a lot of things we're sort of missing on the data side that can really kind of, I think, help us understand how good a protocol is doing. But yeah, I mean, like I really think that it's 2 different things, right? The valuation of a protocol and then the trust factor, and you need TVL in order to have that trust.
And I think 2 small things to mention, and I won't get super deep into Verachain because it's a lot, but if you want, you can check out the DeFi Dojo pod I did. But I think like one of the things that's pretty cool about proof of liquidity is that it actually will enable you in some capacity to identify exactly what your customer acquisition cost is. Which I think is like a pretty important development, as well as like being able to distribute incentives programmatically at the chain level in a kind of like, all right, we're back, in a fairly unsubsidized way. The other thing that is worth addressing, especially from like a liquid fund type POV, is the difference between app revenue and token value. Those 2 things are like potentially really correlated, but oftentimes really not correlated, right? And so, if you're like a Uniswap Labs or AAVE equity investor, you probably feel fucking fantastic to see the core numbers go up. But at the end of the day, like the reality for most token holders is that unless you actually have like organic value pass through of fees, which is something that like we were really focused on for Verachain and you get via BGT, none of it really matters aside from like, a little bit of circle jerking about like the numbers going up. And so, part of this is a regulatory moat thing, part of it's like a reg arbitrage thing, but at the end of the day, like having direct value pass through that is directly, like what you really want to create from a tokenomics perspective is like this product that derives value from the business being successful via its core operation. And I totally agree that like this incentives minus customer value formula is actually really important to get to sustainability. Because that's actually like people treat incentives as like very haram across the board, but the reality is that like things like ad spend, which I treat this as a functional proxy for, is actually like a super useful way of acquiring users. The only thing that's problematic is if you take your loss leader and then start like really losing on it, you need to make sure it's sustainable.
On the token thing that you mentioned, any token that has both token and equity is basically uninvestable because you are in the junior tranche of a decision. If the protocol has both equity and token and they find $1 billion in the backyard, like Uniswap did with the front end switch, they are more likely to give it to the equity where they have more share, where their friends have more share, where their LPs have more share, VCs, than to the token. That's just a bunch of strangers around the internet. So when we're looking at things, if something has both asset classes, both equity and token, we just don't even look. We move on. What you want is a token where the whole team is incentivized to pay revenues to the token, not necessarily this year or next year, but eventually, right? Companies are allowed to reinvest into their businesses to grow. These are all early stage startups, but you need to know that down the line, you're in the same instrument where everybody gets paid eventually.
So related to that,
I was just gonna ask if it's ever gonna shift that way though, because I think like we're still in this like meta where governance tokens that have utility is kind of like not really attractive.
I mean, they've done quite well over the past 2 years, I would say. So there's a lot of governance tokens with utility, and they've tracked their fundamentals decently well. And what you want as a business is something that tracks your progress. So if you get more customers, if you grow, your token goes up, and that's what we've seen with fundamental tokens. Narrative tokens have done well for 2 to 3 months at a time, but then they're down only for years at a time.
Can I push back on this just a little bit? I agree with you broadly. I think where it's a little more interesting and nuanced is that like one of the really powerful things about tokenomics is that you don't strictly have to make this trade-off between delivering value now and also continuing to scale growth now. What I mean by that is that you like using bearer governance token as an example, right? Like if you were to pass through or like internalize that those funds to the corporation, right? You will have some value that's effectively generated by that. But if you pass it through to the users and get some multiple on like the future cash flow generation and growth of the protocol, and then use those tokens kind of like recursively and responsibly to then incentivize and acquire new users because you have a positive ROI formula between my revenue per user and my customer acquisition cost per user, you can actually scale really, really nicely and demand a very meaningful multiple as much as no one cares about fundamentals at the end of the day, because there is actually an ability to project and model these cash flows over like a long period of time and see how it accrues value.
So I would argue that that's exactly right. It's just a matter of looking at the long term, right? It's the DCF. Nobody actually built a DCF, but it's a mental model. It's the cash flow over many years and what the value of those cash flows is. If you're telling me that reinvesting now or paying more incentives now will grow the number in 5 years to 7 years and offset the value that you're paying out now, that's obviously a value positive thing for long-term holders. If you are paying up more value now for narrative, just to grow a metric that the market will trade off of, and it's going to actually hurt your value in 5 years, that is value destructive for the long-term token holders. But the long-term token holder is not focused on this year or next year, it's focused on the whole stream of cash flows over the lifetime of the business. And if the business won't survive 3 or 4 years, you shouldn't really pay almost anything for it.
So that actually gets to something I wanted to bring up is we track, or DeFi Llama tracks the difference between fees, which is everything paid by the user from the user perspective. So think like Uniswap, what you're paying to LPs, revenue, which would be what's captured by the Treasury or token holders, and then holder revenue, which is specifically fees that are captured by token holders. It sounds like you guys are coalescing around revenue is the most valuable of those, but is there anyone who thinks that maybe fees or holder revenue specifically is most valuable? Or that even fees has value exogenously from revenue?
I'll bite on that. Yeah, I think fees are massively important, right? And like at the end of the day, revenue is important for creating sustainability of the token and of the project in some capacity, but fees are just as important, right? In that, like, if you had 60% of Uniswap fees go to revenue, you might sit there in the short term and be like, wow, look at this. This number that we all decided we care about the most is going up, and so this is fantastic. But the reality is that, like, in doing so, you would then like absolutely neuter LP rewards from the trading activity, and as a result, the incentive to provide liquidity would disappear. The amount of liquidity in the protocol would dry up. The amount of volume that you can process and generate fees on will go down, and then as a result, 3 months down the line, your revenue number is down, and you're like, well, why? I improved my fee switch. Like this should have been awesome. And so there's always like a balancing act, right? It's like the two variables of stakeholdership. It's like the people actually providing value to the operations of the protocol, because at the end of the day, these are largely decentralized operations. And then the people that are benefiting from the value in some capacity, right? And then there's like some curve where you're trying to find like the optimal point on the curve of both returning value to the people actually operating the protocol in effect, as well as to the people that have invested in the protocol. That's like pretty classic. That's also why I find this ability to balance returning value via fees as well as increasing distribution or incentivizing LPs in some capacity to supplement, as long as it's kind of like justifiable, is actually like a really important factor, because it allows you to like min-max that relative difference a little bit more optimally, instead of having to kind of like take blind shots in the dark of like what is the correct ratio between these two things. You can actually just like effectively adjust one variable that allows you to touch both.
There's an elephant in the room around like why the fee switches haven't happened, and it's obviously regulatory reasons. And because we haven't had clarity on that, the models around a fee switch become extremely litigious and risky for any protocol, especially like with a US nexus. And that's why I fundamentally think like we haven't kind of gone that direction with a lot of these different protocols. And as we get regulatory clarity, and then there's like staked assets that have a fee switch, and we have a framework for like what becomes a security and what isn't a security, then we'll have more clarity, and the numbers will kind of start to speak for themselves. But until then, it's going to be abstracted vanity metrics until we can actually deliver that value.
The market's still really immature. Like the DeFi ecosystem is still really immature. I could probably count maybe on my hand the amount of protocols that actually submit like an annual report. So like nobody's even like showing like what exactly is going on behind the scenes in protocols. And so I think maybe that's why nobody cares. And it probably could be something like, because nobody's turning on the fee switch, and not a whole lot of people are making revenue or distributing it back to the shareholders or token holders. No shareholders. There's no shareholders. We can cut that piece. But because they're not distributing it back to the token holders, I mean, maybe that's why nobody really cares about value. But value is definitely, though, like I would love to say everybody's looking into it and say, hey, what's the 4-year growth plan for this protocol, and how's the? But it just doesn't work like that. And so as a builder in the industry for 5 years, like that's not what people care about. Or people who are buying and speculating on tokens, they don't care about that. They care about, well, then buy and speculate more of the tokens that I'm associated with. But at the end of the day, right now, what we've seen is it's just, the vanity metrics, the things that the KOLs are saying, like that's what's spurring the speculation right now. But there are a lot of really good protocols, especially those that have been through the bear market, that have built successful, sustainable businesses now in their DeFi protocols. And they're just sitting right now at like the bottom of the barrel, and you can find a lot of them on DeFi Llama. So.
One of the things that we've seen sort of happen in real time is the Solana vanity metrics and how they've affected price. Patrick actually has a really interesting thesis that he brought up during a podcast that we did about how Solana price is directly associated with one of these vanity metrics. And then even more recently, we saw Pump.Fund affected. maybe not. Yeah, with quotes. Recently, we saw Pump.Fund effectively say we might have our own DEX, and so what happened to Radium? The value went down. Why? Because some of those vanity metrics people care about, and they assumed that Pump.Fund's own token would have some additional value that is being taken away from or vamped from Radium, whether that's volume fee. I mean, all the things are related, right? Volume, fees, revenue, effectively the same, or at least highly correlated.
Wait, what is the vanity metric there? Because I mean, that was mostly a revenue thing, right?
I use the word vanity metric to mean any metric that someone would use to promote their asset. So all metrics to me are vanity metrics because you use them. But if we're saying vanity from value, sure.
One quick thing there, I think Radium is a good example on both points. Radium is very well owned by a lot of liquid funds. So there are a number of liquid funds that are the largest holders in the space. There are a lot of buyers in the space, retail buys, but they sell. And what matters for token price is not people who buy and sell, it's people who hold the tokens for a long period of time. And I think liquid funds are the largest holder in the space by a wide margin. And they're all looking at fundamentals to one extent, to some extent. Many of the more recent funds to a large extent, kind of like us. Radium was a very well-owned name by this class cohort. And what they were focused on is that Radium bought back $200 million of shares last year. And a lot of that was through Pump.Fund volumes. So Pump launching an AMM means that number is likely to be 100 million, not 200 million. So it's a direct correlation to buybacks, which is directly correlated to actual value returned to the token. So I think that was actually a pretty efficient market move. Actually, if you look at the price decline, it was 30 to 40%, and pump.fund's percentage of volume was 30 to 40%. So that might be a coincidence, but knowing the players in this ecosystem, it is very much a reflection of future cash flows for Radium.
Going back to your original question on like fees versus revenue, so I think fees are a good indicator of the value created by a protocol, and then the revenue is what's captured. And so I'm a bit biased because Jito generates quite a bit of fees. We often generate more than Solana on any given day, but we also do capture a fair amount of that. But you see some projects that create a ton of value, like maybe a multi-sig, but then they make effectively no money on that, right? So like multi-sigs will have tens of billions of dollars in them. They don't make any money. So it's obviously something with PMF, but it's not a great business. And so I think fees kind of show you what is the potential there, how much value is being created, is it a good product, and then the revenue lets you evaluate if that's a good business or not.
I'll quickly support fees as well. Every metric is just a clue, and you have to peel back the onion. Jito is a great case where fees show you how much revenue could be charged over time. And a lot of people think that Jito is not exercising its pricing power fully. Uniswap token, just leave aside labs for a second. Would you buy Uniswap token for more than $1? You would, because you're earning fees and you know that they can't turn on the fee switch. So every metric is just a clue, and you have to think about one level deeper about what it means for the future.
All right, we probably have time for one more question. And actually, the pump fund Radium example is a good pivot to the next question, which is we talked about valuing protocols based on metrics, but which metrics actually provide a moat for protocols and are more difficult to come and go? Because I think that's a good example where something changed and suddenly there's concern that 30 or 40% of revenue could drop.
Well, revenue can literally provide a moat because it can build a DAO. I mean, we've seen Ohm, I think, is an excellent example of a protocol that built an insane treasury and is still around today despite it sort of losing narrative hegemony for a long time, and people still might not know what it's currently doing. So revenue allows you to have something to tap into during narrative shifts and rebuild. So I would say probably rev over fees there. Because fees, like, let's look at Verachain right now, which I love, by the way. If you're looking at Kodiak, which is a phenomenal DEX, they have like 2% fee tiers. Also, Uniswap now allows you to do 2% fee tiers, but you can create insane fees relative to volume because of the high fee tiers, because you have relatively low liquidity, so people are willing to swap through it. So you would have this incredible metric to promote and use, but that is not a metric that you're going to have for a long time. As liquidity develops there, as capital flows into the chain, fees will probably go down relative to liquidity, because people are going to be willing to vampire attack a 2% fee tier for a 1% fee tier, then a 30 bip, then a 10 bip. And so I think revenue for long term sustainability and like as a fundamental metric would probably be my go-to.
I'm not disagreeing with any of that, by the way. But there's like a pretty fun thing that you can also think about from like a proof of liquidity perspective, which is that if you take your 2% fees and then use those to incentivize via proof of liquidity, you get a nice money multiplier on spend. That money multiplier then means that if that then goes back to the LPs in that pool, means that you can actually probably actually like snowball dominance as well there, right? Because you get the money multiplier on spend, which means the fees will be higher, both from like the volume that's going through it, as well as the incentives that are going on top of it. It's sustainable because it's getting recycled from fees. And then you also then have the deepest liquidity in the 2% fee tier, which means that even if the fee is higher, you can still end up in a universe where you're routing through with better execution.
Okay, I'll just do a quick point on this, because if any of you guys vampire attack a 2% fee tier for just the APR, I will smack you, because there's no reason to do that. If you're getting like a 500% APR, don't vamp into the 1%. Then everyone's going to flow into that. You're going to get a lower yield relative to all of the metrics involved. Exactly, yeah. But one of the things here to note is, like, if we look at the Infrared versus Stride example, love both those teams. What Infrared did is, what Infrared did is they allowed the liquidity to be built up organically on Kodiak at a 2% fee tier and was routing a ton of volume and had a crazy APR. I mean, I was getting like 1,400 for 2 days. I annualized that, and I would have made the entire GDP of the world in 167 days if I was compounding hourly. Yeah, exactly. Whereas Stride took a different approach. They said we're going to incentivize liquidity with like this USDC windfall, I guess you could say, and we're going to say that liquidity can be at a lower fee tier because we're giving it external incentives. So instead of attracting organic liquidity, being provided and eating the fees, they said we're going to have an external. So these are two totally different mechanisms, and I tend to prefer the sort of organic fees over the incentives, but both are, I think, sort of valid models.
We didn't really talk about like you mentioned Treasury, like actual balance sheet assets. There are a good amount of protocols where their actual token valuation is very closely matched to the amount of Treasury assets that they actually hold, which is just insane to me. So, but like looking at like also expenses of the protocol. So like what are they actually paying their developing team, and then like how much cash do they have on hand, and how long can they survive? How much of the treasury is actually in governance tokens, and how liquid is it? How much is in liquid assets? Like all that stuff is sort of the things that I think about, and we have to think about if we want to be sustainable and grow. And I think it's sort of like one missed piece that nobody really ever talks about is, like I know for a fact there are several teams that have fully diluted valuations less than their treasury, which is just insane.
I'll go back to the TVL as the potential of fee generation and revenue generation. Crypto in some way, shape, or form is still kind of like PvP versus like very sophisticated investors and retail investors. And I would say that TVL is a facsimile for like how much revenue and fee potential is actually there. So effectively, like the higher the TVL, the more that can be utilized, the more you can kind of move your brand around and release new products. So I think still TVL to that case is like very, very effective.
We take one more response. We are a little bit over time.
I'll just give some love to TVL as well. I think the moat depends on every business, but for borrow lend protocols, TVL is a pretty good proxy. There are two strong moats in borrow lend. One is if you're the biggest player, people don't get blamed as much for losing money on your protocol, and they're less likely to lose money on your protocol. That's defined by TVL. AAVE has a lot of TVL, so people feel safe depositing in AAVE. One, because it's been audited by the test of time with a lot of TVL. And two, because if you lose money on a fork, you look really dumb and you can lose your job. But if you lose money on AAVE, probably everybody else lost money too. And that's something that does drive behavior. But two, liquidity really matters for both borrowers and lenders. AAVE is probably the only protocol that can take $20 million borrow in the entire universe still. Yeah, maybe one or two more. But it's, it makes it really hard. It makes it really hard for smaller protocols to compete. So in that case, TVL is a moat.
Thank you. Thank you everyone so much
more.
for coming to the panel. Clap for the panelists.